market. That warns. That is a dangerous exchange for physical divergence.
Now, Andrew, earlier on, you did touch on silver and you did catch my attention, and maybe you can bring us up to date in terms of what you're seeing right now for our silver stackers out there.
Oh gosh, yeah, this is such an exciting time, and also an exciting time for anyone in my goodness me. I mean, silver, the most undervalued commodity on the planet Earth. I mean, what an opportunity. I cannot believe it. We're testing 23 today, and what a joke that is. But anyway, these same actors in silver futures are also going to benefit from the Basel III over-the-counter gold positions being increasingly backed by physical. In turn, it's going to force this extremely bloated ratio trade to unwind, which in turn will allow oversold silver to catch up to a rising physically driven gold price. You cannot keep expanding that ratio trade. It's become ludicrous already in the 80s. So while silver futures don't have to be, or silver doesn't have to be NSFR compliant, although really all commodities ultimately will be too, it's going to push the ratio. If it pushes the ratio trade too far out, it's going to backfire. So we would anticipate a residual bullish effect, but margin requirements to initiate the trades that we just saw with CME, it really also favors the commercials. And in this case, with immediate effect, both categories decrease. So in other words, so basically whether you're an HRP or a commercial or you're a speculator, the margins have reduced. But again, it's favoring the commercials who basically can come into a market with 9,500 as an opening trade and a maintenance trade, whereas a speculator has to have 10,450 and then maintenance at 9,500. So essentially, that's where we are immediately with silver, the most undervalued commodity on the planet Earth. But this beggars the question, where was the selling coming from then? So specs trading a 100% cash settled futures market are really conditioned to thinking that chasing a dot on a screen from infinite to zero in a cash settled non-delivery market is a viable trading option. I mean, that's unbelievable. But this is a strategy which is clearly in play. And this is because they don't have any visibility into the physical supply-demand fundamentals underpinning the gold and silver market, nor is it on their radar that Basel III regulations will significantly reduce the paper-driven tailwinds that they are psychologically, psyoped into believing and thinking. Now, the resulting self-fulfilling chart-baited historical trend lines, the moving averages, the paper-centric pivot points, have historically led these speculators into becoming patsies to periodic, insider-driven, led by the nose, self-ignited, sell the rally market waterfalls. Now, these are easy to generate if you've borrowed money off the house. And this is where the banks bankrolling specs who've borrowed these leveraged positions off them rig these paper traders into a position where they can call these loans in at a profit, simply. We've been through this multiple times. It is not rocket science, but without the blinkered COMEX-centric speculators into this mix, the 50 years of price fixing ranges really could not have been managed. But for those of us that monitor the paper to physical balance, and our subscribers, this is what we focus on, the balance, we're trying to balance there's a structural change that is becoming evident between the physical and the paper market. Yes, gold is fundamentally undervalued below 2,000. Oh yeah, why is it not at 2,000? Well, there's reasons for that. But it takes a little time for specs driving this paper gold and silver selling to realize there really is no need to sell the rally into an increasingly physically driven marketplace. So from here on, we will start to evidence a spot market that will increasingly be physically deliverable. But being blind to fundamentals, it will take the resulting option structures, the moving averages, the trend lines to begin to morph into a physically driven market to force a change in spec trading behavior. i.e. they will be wrong at both ends.
Now, Andrew, definitely we want to get into Basel III. Got a lot of questions on that. But just before we do, what do you think this means for the actual price of gold now?
Yeah, Shane, great question. I mean, if anything, as the process unfolds, we're also going to see paper-driven upside price overshoots of steadily rising physical market support. So I can see this going the other way too. Of course, we're used to the downside spec overshoots, which have been the lever for decades of official gold price management. And of course, that's greatly enriched the insiders, the agent insiders. Now, this process is irrevocably underway, but it's like a tanker changing course. It takes a little time to turn. Now, drilling down into the New Year action, the paper-driven automated spec selling has continued to key off these inversely correlated strong bearish bond, rising bond yields, strong dollar crosswinds. Hey, really a strong dollar should not be a weak gold. A strong dollar is often a safe haven move. Safe haven, well, I mean, obviously it's as far as every currency goes, it is a safe haven versus other currencies. But also we sometimes see gold and the dollar rising together. It's been more about the bond yields. Rising bond yields have triggered these sellings, this spec selling. Now, that completely irrelevant to the fact that long-term that real interest rates are negative. But following this action, and again, we'll just connect these dots and we'll get to where we're going now. So following this hawkish Fed, if you remember the hawkish Fed last Wednesday, that perfectly set up the obligatory non-farm payrolls gaming last Friday. We always talk about this. It's always a heavy event. Specs were severely wrong-footed because of these two events. The hawkish Fed tanked the market, the gold market, tanked the stock market. But of course, we knew the Fed would step in there and rescue, stick save that. But again, it left the specs really wrong-footed. But this week, the automated spec-driven selling ran into strong physical buying, and we reported this. But we were reported to this by our January the 4th morning liquidity provider meetings. The physical buying forced commercials, let's face it, unwilling to take fresh short positions. It forced them to stand aside, and they're now reduced. And this is the change in behavior. They're reduced to bid pulling tactics, not adding shorts, with a physically driven undercurrent ultimately overcoming these spec sellers, because it's purely spec selling with the commercials pulling a few bids. Now, commercials they're undoubtedly taking the long side of every blind spec sell order. So really, old muscle memory into rising bond yields and a stronger dollar has evidenced spec sellers appear at every single pit open. You've noticed that. However, this divergent paper to physical action drove the February the February futures contract deep into backwardation. We talked about backwardation, where you've got a further out futures market trading at a discount to the cash market. That warns. That is a dangerous exchange for physical divergence, highlighting that the underlying bullish physical drivers, which is competing against the COMEX sellers, emanates from a strong bottom-up physical demand. So it's the physical market that's beginning to drive this.